Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. The Fed's stunning reversal triggers a market rally, but a crisis looms, consumer confidence crashes, and tech stocks teeter. Is this the calm before a market-wide storm? Second, DOJ versus Google. Judge declares time is of the essence in the historic battle to break up a tech titan. The government wants to dismantle Google's empire, but the company claims monopoly is the foundation of the American economy. Who will win this war, and where is the hidden antitrust alpha for investors? Finally, alarm bells. Wall Street's hidden weak point breached, exposing JPMorgan and Citi. This wasn't just a data theft, it was the theft of a financial weapon. How can sensitive real estate data be used to manipulate markets? And is this the start of a new shadow war against the Western economy? Alert! The markets are buzzing as the Fed's dovish pivot sends tremors through Wall Street. On Friday, we saw a massive shift in rate cut expectations, propelling growth stocks into the spotlight. The S&P 500 climbed 0.98% to close at 6,602.99, with futures indicating more gains as it hovers around 6,622. But listen to me, this rally is masking underlying tensions, consumer confidence is crumbling, and tech sector volatility is on the rise. The real story here is the Federal Reserve's sudden change in tone. New York Fed President John Williams' comments sent a shockwave, flipping December rate cut probabilities from 39% to a staggering 71%. Why does this matter? It signals a potential easing of monetary policy that could be a lifeline for struggling sectors. Yet, don't be too quick to celebrate. The market's backdrop is shaky, with consumer sentiment plummeting and AI capital expenditure concerns looming large. Let's break it down. The Fed's dovish stance is a double-edged sword. On the policy front, Williams' comments suggest that the Fed is ready to cut rates, addressing labour market fears over inflation concerns. This pivot has already jolted the CME FedWatch tool with a 32 percentage point swing in cut probabilities. But here's the catch. Consumer sentiment is in the dumps, with the University of Michigan's index showing a devastating 29% year-over-year drop. This disconnect between Fed optimism and consumer pessimism could spell trouble if spending doesn't pick up. From a money flow perspective, Friday saw robust trading volumes indicating conviction behind the rally. However, don't be fooled. This isn't a broad-based recovery. The advance decline ratio favoured advancing issues, but we're seeing capital rotate into defensive sectors like healthcare and away from high-flying tech names. The Nasdaq remains vulnerable, down 3.2% for the week, as investors reassess the sustainability of AI-driven growth. In terms of valuation, the tech sector is under pressure. The Nasdaq's failure to decisively break its 100-day moving average suggests caution. Growth stocks, particularly those tied to AI infrastructure, are facing a reality check. Companies like Oracle saw a brutal 6 to 7% drop, highlighting fears over unsustainable capital expenditures and client concentration risks. Now, here's a strategy for today. Act now and trim your tech holdings, especially in high capital expenditure names like Oracle and Meta. Rotate into healthcare and consumer staple sectors with defensive characteristics and more stable valuations. I'm telling you, this is your last chance to reposition before the market fully digests these shifts. In the sector spotlight, healthcare is leading the charge. Eli, Lilly, Amgen, and Insight are gaining traction, with the healthcare select sector, SPDR XLV, seeing significant inflows. Meanwhile, tech heavyweights like Nvidia are struggling to capitalize on strong earnings due to broader market skepticism about AI's future. Keep an eye on Alphabet, which is bucking the trend with its Gemini 3 launch and Berkshire Hathaway's backing, suggesting a potential bright spot in an otherwise cautious tech landscape. Good advice makes you rich. Bad advice costs you a fortune. Listen to me. In the short term, 1 to 2 weeks, if the Nasdaq can't reclaim its 100-day moving average, underweight tech by 15 to 25% and increase healthcare exposure via XLV by 5 to 8%. For the medium term, 1 to 3 months, should consumer sentiment show any signs of recovery, add to consumer staples, XLP, by 2 to 3%. And for defensive positioning, increase cash holdings to 12 to 15% for flexibility amid volatility. For hedging, advanced investors should consider buying put options on Oracle to protect against further declines. Intermediate investors can use inverse ETFs like SQQQ to hedge against tech sector weakness. Basic investors, simply increase your cash position to weather potential storms. Time's ticking. Let's dive deep into today's critical market dynamics. A US federal judge just put Google on the clock, declaring that in its massive antitrust case, time is of the essence. This isn't just a legal warning. It's the opening shot in a battle over whether to break up one of the most powerful companies in the world. The Department of Justice is not holding back. Their demand is for nothing less than a forced sale of Google's ad technology business. A DOJ attorney argued in court that the remedy needs to eradicate Google's illegally acquired monopolies root and branch. The target is Google's ad exchange, AdX, a platform where the company takes a 20% fee from online publishers just to sell their ad space. This potential breakup is creating what investors are calling an antitrust alpha opportunity. The thinking is that if Google is forced to sell its ad assets, it would immediately open the door for competitors. Firms like The Trade Desk or Magnite, which are independent ad platforms, could see a huge surge in business and market share. This provides a very tangible investment thesis directly tied to this legal outcome. Beyond the investment angle, a forced breakup could also trigger significant deflationary pressure on digital advertising costs. Right now, Google's dominance keeps prices high. If competition increases, the average cost for businesses to place ads, a metric known as CPM, could fall. This would directly lower customer acquisition costs for countless companies, potentially easing services, inflation, and boosting profits for any business that advertises online. This all comes after the judge already ruled that Google does, in fact, hold illegal ad tech monopolies. The question is no longer about guilt, it's about the punishment. But Google is fighting back, calling a forced sale an extreme measure. In a stunning defense, Google's attorney argued that lawfully acquired monopoly power is the foundation of the American economy, citing a Supreme Court ruling. Now, get this, Google's defense isn't just a bold claim, it's rooted in a key legal precedent. The key here is a 2004 Supreme Court case, Verizon vs. Trinco. In that case, the court ruled that simply having a monopoly and charging monopoly prices is not illegal. The law only steps in when a company uses anti-competitive conduct to get or keep that monopoly. So Google is essentially arguing its dominance came from having a better product, not from illegal behavior. A ruling against Google now could redefine what counts as illegal monopolization for the entire digital era. They claim a breakup would be technically difficult and hurt customers, setting the stage for a years-long appeal that could delay any real-world consequences. However, if you zoom out, you'll see another layer of strategy at play here. The delay itself is a strategic weapon. There's a concept called remedy lag, and it can freeze an entire industry. The prolonged legal uncertainty could halt mergers, acquisitions, and venture capital investment into the ad tech sector. Why would an investor pour money into a small competitor if Google's fate is unknown for years? Paradoxically, this lag could end up cementing Google's dominance for the foreseeable future, even if it ultimately loses the case. The situation presents a fascinating duality. On one side, you have the government pushing to dismantle a key part of Google's empire to restore competition, while on the other, the tech giant is defending its dominance as a fundamental part of American business. We're seeing the US pushing for a structural remedy, literally breaking up the company. At the same time, the European Union is taking a completely different path with its Digital Markets Act, or DMA. It sets rules for how gatekeeper companies like Google must behave to ensure fair competition, but it doesn't break them up. This forces global tech firms into costly, fragmented compliance, and some analysts suggest it may cede strategic ground to Chinese tech companies that can operate globally under a single state-supported model. The judge has made her impatience known, but with Google signaling a massive legal fight ahead, the future of the internet's advertising economy hangs in the balance. So the question now is, what's the next move? The key focal points will be any rulings on Google's expected appeal, as that will determine the timeline. From an economic perspective, keep an eye on M&A and venture funding data in the ad tech space to see if that remedy lag is indeed freezing investment. And for those interested in markets, the stock performance of competitors like the Trade Desk and Magnite will be a leading indicator of how investors are betting this will all play out. Speaking of risks rippling through our digital economy, a massive cyber attack has just exposed a critical weak point in the financial system, potentially compromising client data for giants like JPMorgan Chase, Citi, and Morgan Stanley. But the attack didn't hit the banks directly. It struck a critical weak point, a third-party technology vendor. This is where the situation takes a more complex turn. Banks outsource specialized tasks to vendors like SitusAMC to improve efficiency, which sounds smart. But this strategy concentrates immense risk in just a handful of outside companies. And, regulators are already keenly aware of this. In fact, just last year, US federal agencies issued new joint guidance to force banks to get a better handle on their third-party relationships. The clear signal is that banks can't just pass the buck. They are ultimately responsible for their vendors' security. The vendor, SitusAMC, a key player serving real estate lenders, confirmed it was the subject of a cyber attack on November 12th. In a stunning admission, the company stated that data relating to some of our clients' customers may also have been impacted. The exposed information isn't just names and addresses. It includes sensitive corporate information like accounting documents and legal contracts tied to client dealings. Here's where it gets interesting. SitusAMC specializes in commercial real estate data. Believe it or not, this isn't just about privacy, it's about market stability. In the hands of malicious actors, this kind of sensitive data could be weaponized. Think about it. An attacker with access to confidential loan agreements and property financials could execute targeted short-selling strategies against real estate assets or use the information to manipulate high-stakes negotiations. This adds a completely new and dangerous layer of risk to an already distressed commercial real estate market. While the vendor has not publicly named which of its major bank clients were affected, the potential exposure at institutions like JPMorgan Chase, Citi, and Morgan Stanley has sent a clear signal through the industry. The core issue here isn't just a single data breach. It's about the systemic risk embedded in Wall Street's supply chain. What really brought this to a head was the realization that this elevates the problem from a corporate one to a national security issue. The vulnerability of these financial data vendors highlights a new frontier for geopolitical conflict. Security experts have been warning that state-sponsored hackers could target these weak points not just to steal money, but to actively destabilize Western economies. This means a cyber attack on a company you've never heard of could be part of a much larger strategic game linking global market stability directly to geopolitics. Even with billions spent on cybersecurity, the financial giants remain vulnerable through the partners they rely on. In response, the FBI director stated that while they are working to understand the extent of the impact, they have identified no operational impact to banking services. That's the key phrase, operational impact. It means the banks are still running, but it says nothing about the sensitive client data that may now be compromised. SitusAMC reports the incident has been contained and that no encrypting malware was involved. However, this attack demonstrates a powerful truth about modern finance. The security of the world's largest banks is only as strong as their weakest link. While services continue, the true cost of this data exposure is a story that is still unfolding. So where does this leave us? First, expect the cyber insurance market to react swiftly. Supply chain attacks like this will almost certainly accelerate the hardening of that market, meaning rising premiums and much stricter underwriting rules. This directly increases operating costs for banks and other financial firms. Second, this breach will put immense pressure on regulators to act. We could see a new wave of regulations designed to police vendor relationships, further increasing compliance costs and potentially causing banks to tighten their lending standards to offset the expense. The ongoing focal point will be how these financial giants and the regulators who watch them respond to secure this critical and now obviously vulnerable digital supply chain.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.